How you doing, everybody? It's Ryan McCurry here, owner of McCurry Financial Solutions and RBlackApparel.com, with the financial tip of the week, Financial Fridays. So the financial tip of the week this week is bonds. So someone brought it to my attention, like, you always talk about stocks all the time. What about bonds? I was like, yeah, that's an interesting question. Let's talk about bonds. So a lot of people aren't that familiar with bonds. So bonds in itself, they're debt. So as opposed to stocks, stocks are equity. Equity is when you have ownership in a company. So if I own stock in Apple, I have equity. I have ownership in that company. If you hold a bond, you're like a creditor. So you're holding like debt. So that's just the general difference. I mean, you can get real and deep in like what type of bond, like, government bond, municipal bond, zero coupon bond. They're all different types of bonds, but the main difference between stocks and bonds are stocks are equity ownership, bonds are debt instruments. So with bonds, for me personally, I hold bonds within mutual funds. So I don't hold any individual bonds, but I do hold bonds within mutual funds. That's how you stay well diversified. So it's like a Vanguard fund I have. It's like called the Balance Index Fund. I think it's like a 60-40 split. It might be like 60% in stocks, 40% in bonds. So that right there gives me bond exposure. So and just in one mutual fund, with mutual fund you have thousands of different stocks and bonds, as opposed to just investing in individual stock. Like I want to buy a share of Apple for $100 and some dollars. With the mutual fund, a whole bunch of stocks and bonds are all lumped together in that one fund, and you invest in that one fund. So the bond exposure I have personally is through a mutual fund, like a balance fund that holds stocks and bonds. So with stocks and bonds, they have an inverse relationship. So usually as stock prices rise, bond prices go down and vice versa. So if you see the stock market crash, usually bonds do pretty well where they may be stable during the stock market crash. So the reason why people may have a balanced fund, like a fund that holds 60% stocks, 40% in bonds, if the stock market crashes, you want to protect some of that money because it's not heavily invested into stocks. If you have a mutual fund like a total stock market index fund that's 100% equity, if the stock market crashes, that fund's going to get hit real bad. But if you have a balanced fund that has some bond exposure in that one fund, if the stock market does crash, you won't be hit as hard as opposed to if you were 100% in equities. So the difference is stocks and bonds have an inverse relationship. So as stock prices rise, bond prices usually decline. If stock prices go down, bond prices usually go up. So that's the inverse relationship. And then some people want to hold individual bonds, so you can go to like a broker and buy like an individual bond. Like when you're little, someone might have bought you like a savings bond, but those don't really pay any interest. So you can buy like an individual bond. I believe you still can get them nowadays, but they don't really pay any interest. So it's like if you go to a bank and you say, I want to invest in a CD. All right, you can get a bank through a CD, but you're going to get like 1% interest. That's nothing. So people don't usually get individual bonds because they don't really pay much interest. So usually when people are older, they may invest in bonds because they want to be less risk adverse. So people who don't want to take a lot of risk in the stock market, they go in bonds because they're safer. Typically, bonds are safer than stocks. Stocks are a lot more risky, but the more risk, the more potential for gains. So if you don't take a lot of risk with a bond, then you probably won't earn a lot of money. With stocks, if you do take that risk, then over the long term you will gain more and you have the potentially for your investment to grow more. So that's just the financial tip of the week, bonds. I wanted to give some information on the difference between stocks and bonds because I do always talk about stocks. We never talk about bonds. So with bonds, like you said, you can hold them in a mutual fund. You have individual bond, but they're typically more safer than stocks. So they're not as risky as stocks. So it's Ryan McCurry, financial tip of the week, bonds. If you want more information, go to my website, McCurryFinancialSolutions.com, or go to RBlackApparel.com. Still got the cooperative economics. I'm saying, still got the hoodies. Still got the hoodies, still got the shirts, so get with me. I'm taking over. I don't care. I'm coming to every city, every hood. We pushing cooperative economics. Stop giving all your money to white people. Stop giving all your money to Koreans, buying hair and nails and all that. That's cool. I know you will look good, but we are sending their kids to college off of our money. Let's send our own kids to college with our money. Put in the 529 and send our own kids to college. So cooperative economics, everybody's been supporting. I love y'all. We keep pushing. keep pushing every day. Grind every day, no days off. Cooperative Economics, go to ourblackapparel.com or go to McCurryFinancialSolutions.com to get more financial tips. I have financial courses coming early in the 2017 year.